Hey everyone, ready to decode 30 absolutely crucial candlestick patterns? Look, I know we all understand the basics of charting, so we're going to skip the intro stuff and dive right into the deep end. We're talking the real psychological meanings behind these visual cues, how to spot true market momentum, and more importantly, how to avoid getting trapped. Let's get right into it.
Here's our roadmap for this explainer. We're moving from 1 to 2 to 3 candle formations, then looking at trend continuation patterns, and wrapping it all up with some essential trading rules.
All right, starting off with Section 1, Single Candle Patterns.
Okay, the golden rule of single candles, they literally mean nothing in isolation. The preceding trend is everything. Take the hammer and the hanging man, for example. Visually, they're the exact same shape, a small body with a long lower wick. But they mean totally opposite things depending on what the market was doing right before. If a hammer forms at the absolute bottom of a downtrend, that's a bullish reversal signal. But if that exact same shape forms at the top of an uptrend, that's a hanging man, signaling a bearish drop. And the wildest takeaway from our source material here? Color really doesn't matter as much as context. A green hanging man is still bearish, and a red hammer is absolutely still bullish.
It's the exact same deal with the inverted hammer and the shooting star. Again, they look identical, like upside-down hammers with basically no bottom wick. But their predictive power? It's all about whether the market was falling or rising before they showed up. An inverted hammer in a falling market shows buyers are trying to push the price up, so it's bullish. But man, if you see that same shape after a long uptrend, that is a shooting star. It's a huge warning sign that the price is probably about to fall.
Now check out this brilliant illustration of sheer market indecision, the spinning top. The source material actually compares this to a latu, which is the traditional spinning toy. It's got this tiny body completely squished between equal upper and lower wicks. Basically, the buyers pushed up, the sellers pushed down, and nobody won. They tied. So, whether this forms in a bullish or a bearish trend, this latu means you've got to hold your horses. You have to wait for the very next candle to break the high or the low of the spinning top just to confirm where the market is actually heading next.
Moving right along to Section 2, Dual Candle Combinations.
So when we add a second candle to the mix, the story gets a whole lot richer, because the interaction between two consecutive candles paints a much clearer picture of who's really in charge. The core concept here is one side just completely overpowering the other. Think about a bullish engulfing pattern. The market's down, you get a small red candle, and then bam! The next green candle opens lower but surges way up to completely swallow or engulf the previous red body. It's a violent shift in control straight to the buyers. The bearish engulfing is the exact opposite. You get a massive red candle swallowing a green one right at the top of an uptrend. The sellers have aggressively taken the wheel.
Now, the visual metaphor for the harami pattern is actually super fascinating. In Japanese, harami translates to pregnant woman. And you can see why, right? The first candle is this large mother candle, and the second is a much smaller baby candle that's completely contained inside the mother's body. Psychologically, this tells us that the market's aggressive momentum has suddenly hit a brick wall. It's just contained. Now, it's not a guaranteed reversal quite yet, but it's a massive, flashing warning sign hinting at one as long as the third candle confirms it.
Let's contrast a few of these dual patterns to see how they create clear market barriers. A harami cross is exactly like the pregnant woman's setup we just looked at, except the baby is a doji, a tiny little cross that screams extreme indecision. Then we have the tweezers. A tweezer bottom happens when two candles hit the exact same low price. Boom! That creates an immediate, undeniable floor of support. A tweezer top? Two candles hitting the exact same high, which slaps a sudden ceiling of resistance on the market. They act as literal, immediate visual barriers on your chart.
Okay, pay close attention to the strict 50% rule that governs both the piercing line and the very ominously named dark cloud cover. For a piercing line, after a red candle, the next green candle gaps down, which honestly looks like more doom and gloom. But then it rallies hard and pierces upward, closing above the 50% halfway mark of that prior red candle. That 50% threshold, that is exactly what validates the bullish reversal. On the flip side, the dark cloud cover gaps up, but then the red candle crashes all the way down below the 50% mark of the previous green candle.
Let's step it up. Section 3, 3 candle formations.
Because 3 candle formations unfold over 3 distinct time periods, they give us a lot more data, making them highly reliable signals. Take the 3 white soldiers, for example. These guys represent overwhelming market dominance. We're talking 3 consecutive large green candles with basically 0 upper wicks. It's uninterrupted, aggressive buyer dominance, signaling a really powerful trend reversal or continuation.
And then you have the total opposite, 3 black crows, 3 massive red candles, no lower mix. Seeing these crows means sellers are absolutely dominating, driving the price down without even a single second of hesitation.
Let's walk chronologically through the really elegant setup of the morning star and evening star patterns. Step 1, you get a strong trend candle. Step 2, the market gaps to a tiny indecision candle. That's the star of the pattern. Step 3, the market violently gaps in the totally opposite direction, printing a large reversal candle that covers more than 50% of that very first candle. It's poetic, really. The morning star dawns a brand new bullish trend, while the evening star brings the darkness of a bearish drop.
Let's connect this back to something we already covered. Remember the pregnant women harami setup? Well, the 3 inside up and 3 inside down patterns are literally just the logical completion of that exact setup. You've got the mother candle, you've got the contained baby candle, and then, this is the crucial part, the third candle decisively breaks out above or below the mother candle. It's the market finally confirming the exact reversal that the harami was only hinting at earlier.
And here is one of the most striking, visceral metaphors in all of trading, the abandoned baby. Just look at how completely isolated that middle doji candle is. It is separated by a massive gap down from the first candle, and then a huge gap up to the third candle. Visually, it just looks totally left behind. The psychology here is intense. Think about it. Traders who sold at the bottom gap are completely, hopelessly trapped when the market violently gaps up the next day, which just adds rocket fuel to a massive reversal.
Speaking of violence in the markets, let's talk about the kicker patterns. I mean, the name really says it all. Imagine a strong downtrend with a big, ugly red candle. Suddenly, the very next candle doesn't just open a little higher. It completely gaps way above the previous candle's open and just surges green. The price was literally kicked in the opposite direction. Whether it's a bullish kicker flying upwards or a bearish kicker plummeting downwards, that massive gap signals a sudden, ruthless, no-looking-back shift in market sentiment.
Okay, so we've seen a ton of reversal patterns so far, but I want to pose a question to you. What happens when the market violently pauses, throws up all these crazy signals we just learned, but doesn't actually reverse? What if the market is just trying to trick you?
That brings us to Section 4, Trend Continuation Patterns.
You see, these continuation setups are completely designed to shake out the weak hands. At first glance, they look like terrifying reversals, but in reality, they're devious little traps. Take the highly confusing 3-line strike. Imagine you've got 3 strong green candles moving up. Beautiful, right? Then suddenly, a massive 4th red candle crashes down and completely engulfs all 3 of those previous greens. Visually, it looks like a nightmare bearish engulfing pattern mixed with a total crash. You'd be so tempted to panic sell. But it's a trap. It's literally just a brief, extreme pullback to clear out orders, and the 5th candle will gap right back up and resume the original upward trend. Crazy, right?
You can actually see a very similar, though maybe slightly less violent, breath-catching dynamic in the rising and falling 3 methods. You get one massive trend candle. Then the market basically just takes a nap. You get 3 tiny counter-trend candles that stay completely inside the range of that first big one. The market is just catching its breath, consolidating its energy, before a massive 5th candle explodes outward, breaking out and continuing that original trend.
And finally, Section 5, Essential Rules for Trading. We have covered a massive amount of structural knowledge today, but before you go applying these patterns to live charts, we absolutely need to talk about safety rules. If there's one quote, one heavily repeated lesson from all our source material that you must permanently burn into your brain, it is this: context is king. A pattern means absolutely nothing without the context of the prior trend. A hammer isn't a hammer if the market isn't going down first. You must respect the context before you analyze the candle.
Let's rapid fire through these critical survival rules for technical analysis. Rule 1. Always identify the preceding trend first. Rule 2. Have some patience. Wait for the subsequent candle to actually confirm the pattern. Do not jump the gun. Rule 3. Never, ever trade purely on candlestick visuals alone. And Rule 4, the absolute most essential rule, heavily stressed in our sources. Always use volume indicators as your final confirmation. Because at the end of the day, a pattern without trading volume backing it up is literally just a drawing on a screen.
And that wraps up our explainer. We've journeyed all the way from single indecision candles to some seriously complex 3-line strikes traps. So now that you are armed with the structural blueprint, here's my question for you. Which visual signal are you going to actively look for in your very next chart analysis? Thanks so much for hanging out with me, and I'll catch you in the next explainer.